The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Stocks ending the week in the red as earnings season winds down and trade talks heat up. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Dill. Welcome back.
Thank you.
You
I
jet
appreciate
lagged?
it. I'm not jet lagged, but I've got some beef with JFK. More on that in a minute.
I mean, yeah, let's just leave it at that. All right, here's what we got. Absolutely nothing on all the major asset classes. We're reversing kind of the moves that we saw yesterday. S&P completely flat. The VIX a touch lower. Crude kind of getting the momentum back from yesterday, and the 2-year yield flat. So it's a pretty boring board, but it seems, Romaine, I'm hearing a lot from investors that we're just kind of renegotiating, hedging, and positioning into the weekend after the tremendous rally that we did see.
I like the use of your word renegotiating because I think that really does fit. And now the good news, at least for equities right now, is that the losses on the week are relatively modest. The selling pressure has been contained, and you see that with the flip-flop back to the upside just a few minutes ago. And then when you look at upside market breadth, that's also flipped from oversold to neutral. But of course, the big asterisk is that volume and momentum continue to lag, which is pushing more and more of the bulls to actually use the options market as a weapon to bet on an extension of the rally. More on that in a second. But the bulls, they actually might be in for a bit of a Sisyphean struggle here because the spread between bullish and bearish sentiment, that remains deeply negative according to the latest AAII readings. Furthermore, you have market exposure from those CTA trend following funds. That remains flat. And then you have all this cash continuing to pile up on the sidelines. Money market funds posting their largest inflows in 9 weeks. Meanwhile, you have U.S. stocks still in the middle of the largest outflow in 2 years. So the risk now is the potential to be range-bound for some time as the Fed sits on his hands. Earnings season winds down and a spate of economic data comes down the pike. And any boost from the start of U.S.-China trade talks or Trump's tour of the Middle East, that may actually fall short. As Bank of America strategist Michael Hartness says, most of the upside already priced in, as many investors have been buying on the expectation and selling on the fact.
That's right, and especially as we head into this very interesting weekend. So this is also a way to look at positioning. This is the put-call ratio. So usually when it goes higher, there's more demand for puts, but we flipped it. So you can really see the outperformance of calls, and you can see just in the last couple days, much more calls than puts. So the question remains, Romaine, have we seen the kind of buying that we need to see on any kind of trade deals, and are we now overvalued? Or is this kind of the time to sell? Now, you take a look at Citi, and they say if you have an S&P that moves less than 2% on the up or downside, you're going to have to see those volatility control funds buy a lot of equities. If you look at, say, the 20,000 level, which we're sitting right out there for the NASDAQ 100. So just by staying at these levels, Romaine, do those funds actually push it higher? But that's not fundamental buying at the end of the day.
Yeah, and I am curious whether this is a market really being driven more by technicals and some of the other issues rather than those bottom line fundamentals. Let's pose that question to our first guest as we kick you off to the close here on this Friday afternoon with Brenda Juanas, Senior Vice President and Financial Advisor at UBS. All right, Brenda, I mean, there's been a lot of talk about that sort of renegotiation of certain people's portfolios and the idea that are you trying to sort of hedge against a downside or are you actually chasing growth to the upside? What are you seeing?
So thanks, Romaine, for having me on. And Alex, let me talk about first what investors have actually been doing in the last 6 weeks. I mean, I have not seen massive going to cash or, a change of risk profile. What clients have been doing have been tax loss harvesting in April. There's a 150 basis points of after-tax returns. We have been putting on hedges on concentrated stock positions. We've been doing that on broad U.S. market exposure. Now, clients have also started to be opportunistic. We're looking at those oversold opportunities. Things like when that 10-year was at 4.5, we were buying fixed income. With this market run up in U.S. equities, we're actually taking some of that money out and redeploying it into European stocks. We're also still looking at option strategies to leverage that upside. So a lot of what you and Alex were talking about in the lead up to having me on.
So is there a sense here, though, too, when we talk about dry powder, if you will, and you obviously, help to manage a lot of funds for ultra high net worth individuals. But we've looked at this cash pile on the sidelines, whether you're using the money market as a barometer or some of the other measures here. Are they willing to deploy that capital anytime soon, or are they content to take, whatever 3, 4, 5% they might be getting in the short-term fixed income market?
Romaine, I think it depends where you're deploying. For example, I've had clients that have been sitting on cash for the last 2 years, and they've watched the S&P up 23, 24%. The valuation was too expensive. 22 times forward PEs was not a place they were willing to step in. When the S&P was under 5,000, we put some money to work, but we're not there anymore. You know, our UBS call on the S&P is 5,800. That's not too far away from here. So I'm not looking to deploy in U.S. equities. I think you have to look outside of the U.S., and that's what's really been interesting to clients.
But that's what's interesting, too, is that those 10% tariffs look like they're here to stay no matter what the trade deals are, and that's going to affect every country. So how do you find one that's kind of spared?
Right. I think the market can handle a 10% global tariff. At the end of the day, Alex, this comes back to a valuation story. If you look since 2020, the S&P has outperformed global markets by 40% on the back of U.S. tech, on the back of American exceptionalism. There's been a cost to the outperformance, and that's to valuations. U.S. valuations are 32% over global markets or global peers. And so when I look to Europe, Europe is not only trading at a 10% discount to its historical values, but we're also in a situation now, Alex, where, you know, US and European GDP is roughly the same. This doesn't always happen. So I think that from a risk adjusted perspective, even with a global 10% tariffs, outside of the US still looks interesting.
So that's sort of where you want to get some juice. Where do you want to be for safety? Because I have a really hard time looking at gold on record high after record high and seeing what's going to dent that.
I know. You know, Alex, before coming on, I looked at those gold figures. We are over 40% on a one-year basis. So it's hard for investors to, understand how they're still upside from here. But our view is that it goes to 3,500 by the end of the year. And it's really predicated on a few things. Number one, we know that there is a de-dollarization from some of the central banks. We know that gold is a beneficiary of this. We also know that, some of these institutional investors have been stepping in to gold. So that is propping up prices a little bit as well. And, even with the trade resolution yesterday with the UK, and even if something happens over the week, and with China, there is still some geopolitical risk. Gold is still a great safe haven play there. And I think that the way I'm thinking about gold is that it's not just a panic play anymore. It needs to be in the portfolio for a broader buffer.
Where does the dollar fit into all this, Brenda? Because, in theory, we should be seeing a little bit more of an embrace of the dollar. But, of course, you also have an administration here in the U.S. that, at least publicly, has kind of made it clear that it would actually be okay with further dollar weakness.
Yeah, Romaine, it depends on what timeline you're looking at for the dollar. I think at these levels, you could potentially see a short-term rebound. We're oversold in our point of view. On a mid to longer term perspective, though, we do see dollar weakness. Look, GDP is going to be more muted in the U.S. We're not going to have 3% GDP like we've seen in the last few years. We know those U.S. deficit numbers at 6%, 6.3% of global 6% of GDP, and so we still see that there's an opportunity to kind of take advantage of U.S. dollar strengthening, buying into home currencies if that is relevant for the investor, but opportunistically going into some of those cyclical currencies like the Aussie dollar. We're looking at the euro, but I think more broadly we can expect to see U.S. dollar weakness.
And just to kind of wrap this up and sort of circle back to, I think, what could be a potential catalyst next week and maybe beyond, if we do see meaningful progress on some of these trade deals, or at least the sense here that maybe the worst case scenario is not going to happen, how much of a snapback? I know you said that 58 is your target, at least on a year-to-date basis, but is there any sort of argument to be made that we could get back at least near some of those all-time highs that we hit in February?
I don't think so. I think we'll be lucky to be flat this year. Going into 2026, we have a 275 earnings per share target on the S&P, which is up, you have upside of 10%. I think we have priced in a lot of the big gains from here. You can look at opportunistically at certain sectors, but I think there's going to be more volatility, and I don't think it's improbable to trace back to 5,300, 5,200 at this point.
All right, Brenda, great stuff. Have a wonderful weekend. Brenda O'Connor Juanas, Senior Vice President and Financial Advisor at UBS. She's kicking us off to the closing bells here on this Friday afternoon with a closer look at some of the big individual movers on the day, and that includes Expedia, second biggest decliner in the S&P 500 today after cutting its gross bookings forecast. We're going to talk about travel trends and, the health of the consumer.
All right, speaking of outlooks and quarterly results, we're going to break down the earnings out of Akamai with the infrastructure software company's CEO, Tom Leighton.
And more talk about the trade wars, more talk about economic uncertainty, and more talks about trade talks set to kick off tomorrow in China between the U.S. and Chinese leaders. Mary Lovely, senior fellow at the Peterson Institute for International Economics, joins us to discuss all that and more. Coming up in a bit, this is The Close on Bloomberg. Well, the Milken Institute Global Conference just wrapped up out in Beverly Hills. I was out there along with Carol Master and Sonali Basak, and we had a chance to catch up with several of the big names in business and finance. Of course, everyone there looking to make deals, and a lot of people there looking to finance them as well. We had a chance to catch up with Peter Toll, who actually helps to run the M&A business over at Barclays. Take a listen as to what he had to say.
From a new issue perspective, things are definitely back. If you break up the credit markets, the primary credit markets, into investment grade and non-investment grade, the investment grade markets didn't skip a beat. Companies kept accessing the markets. Investor demand was there. Order books were well oversubscribed. The below investment grade market definitely hit a pause. Those companies are smaller, more levered, therefore more vulnerable, and I think the investment community, the investor community took a step back. So there was a good 2 weeks where there was a pause in new issue activity. But since then, all the indices have traced back, and yeah, we're back to basically where we were, which is fantastic.
When you look at spreads, though, so spreads have come back down to where we were just prior to...
Spreads have retraced almost to where we were on April 1st. There's been more decompression. So there are companies that are going to be more vulnerable to tariffs, more vulnerable to, say, consumer discretionary. And so those spreads have widened out. There's been definitely more decompression in the market. But largely, the indices have largely come back, just like in equity.
Okay, and what's the transparency, or the relative transparency you have right now on really accurate price discovery? Is that there?
Yeah, no, I think it is. Like I said, investment grade spreads went from, say, 85 out to, 120, and now they're back into, say, a little over 100 basis points on average. And there's really good demand, really good price discovery in the new issue market. In the high yield and leveraged loan markets, there is less so. We haven't really tested the triple C end of the market, the really more risky side of the market. But we're seeing good demand and a broadening out of the market. So we started with double B issuance, went to single B, and we still, to some degree, are waiting on the more risky side.
Realistically, investors are still pretty nervous. How much appetite is there to invest in the riskier parts of the credit market anytime soon?
I mean, one thing I'm hearing here at Milken is an absolute mountain of money that's been raised to invest in credit. And while the new issue market, like I said, in below investment grade has widened out from double Bs to single Bs, and we haven't really tested the depths of the market of triple Cs. I think investors are really excited about the opportunities that this backdrop will present to them. And so, one of the things I'm hearing here is just an excitement about deploying capital in higher yielding situations.
So what's interesting to me about that is we are still in the midst of tariff uncertainty. You don't know really how these companies are going to play out in terms of margin pressures, changes in business. So how long do they have to wait to invest? You said there's a mountain of money. Is it just sitting there?
Yeah, so one thing I'll say on your backdrop, because I agree with you, the world is a risky place, right? There are potential trade wars, real wars. The word stagflation has entered the vernacular, right? That's never something that causes markets to be comfortable. But I think what you're seeing right now, whether it's equity prices or credit spread prices, is the markets seem to be pricing out the worst case scenario. Now, it doesn't mean we can't go back there, but right now, like I said, things have retraced and the worst price scenario seems to be off the table. We'll see what Chair Powell says this afternoon.
Given some of the uncertainty, that backdrop that Sonali was laying out there, is it possible that some of those M&A deals might not be as reliant on financing, meaning more cash deals or stock deals that maybe X's out, folks like you?
It could be, and look, I'm not an M&A expert. I'm the new issue credit guy, but what I will say is this: what our economists are calling for is a slowdown in GDP growth, but not falling off a cliff. An elevation of consumer prices, but not getting out of control. And that's an environment where you can price risk assets, right? You may not like a slowing economy, you may not like elevated inflation, but that backdrop where things are manageable allows boards to make strategic decisions. No one likes uncertainty, and we've certainly had a lot of uncertainty. But if it plays out like our economists think it will, I think there's a scenario where M&A can continue to rebound.
Peter Toll, the global head of fixed income over at Barclays. We caught up with him at the Milken Institute Global Conference in Beverly Hills. And, you know, Alex, all of the talk really was about a potential increase in M&A activity. And more importantly, this idea that whatever disruptions we had because of the first 100 days of this administration, most people think that was just basically M&A deferred, not necessarily lost long term.
Well, I mean, of course they did.
Yeah.
They definitely want to manifest that, right? But we've been hearing about an M&A cycle for a long time now, and we still have yet to see it. And if we keep getting the uncertainty, when does delayed become done? Yeah,
and that's a big question there. So, of course, they're paid to be optimistic and paid to sort of look for opportunities, and there was a lot of it out there. And, of course, we spent a lot of time out there at Milken talking about what was going on in private markets. When we come back after the break, refocus on public markets. A closer look at some of the big names moving today, and that includes Sweetgreen, having its worst day in about 2.5 years after the salad chain cut its annual guidance saying tariffs are hitting the consumer hard. That's coming up next here on The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations, and we start off today with Affirm. Susquehanna actually upgrading to positive and setting a price target of $65 on the stock. The analyst saying yesterday's earnings results from the payments company, while mixed on some key measures, still overall came in well ahead of expectations. Those are the words of the analyst. Investors, though, not feeling it, pushing the shares lower by 14%. Next up, Wolfspeed. Citi downgrading the semiconductor products company to sell and slashing the price target to $3 from $7. The analyst says Wolfspeed faces significant financial challenges in a sluggish macro environment. Investors feel the same way, pushing those shares down 24%. And finally, Lyft. Goldman Sachs lifting its rating on the rideshare company to buy on a compelling risk-reward valuation amid what it calls a stable industry backdrop. And you take a look at those shares. Lyft higher by 28% on the day. And those are some of our top calls. Well, the flip side of what we're seeing with Lyft is, well, Sweetgreen down about 19% here. The salad chain not having not so sweet day after cutting its annual sales outlook and saying the announcement of tariffs in the U.S. has already hit on consumer sentiment. Joining us right now to discuss is John Tower, equity research analyst at Citi. He's got a buy rating on the stock. All right, so let's break this down here. When we talk about the tariff impact on Sweetgreen, are we talking about the cost of their goods and materials, or are we talking about the way down on consumer sentiment and the broader economy?
More than the latter. So they said everything was humming along relatively well month of March, and effectively post-Liberation Day, along with consumer sentiment, their business effectively just dropped off a cliff. Keep in mind, they're a fairly small concentrated concept that has a very large footprint in New York, LA, Boston, DC, and, 250 stores or so across those markets. They saw a fairly big retrenchment in demand right after the Liberation Day came through. So it's not a direct impact really on their business. They said in the second quarter, because of some packaging, they're going to see an uptick in about 75 basis points from tariffs, and that's going to fade as the year goes on. Yeah. And then some equipment costs for their Infinite Kitchen move a little bit higher to the extent they can't mitigate them as the year goes on. But direct impact, no, not that much.
Well, on the Infinite Kitchen, these are the more automated types of stores that they're trying to open up here. So is the idea there that it's the cost to open those stores and get the equipment to open those stores that has some tariff exposure?
Yeah, and we estimate based on what they talked about last night. Well, first and foremost, that was one of the bigger concerns going into the quarter for investors. They had issued in their 10K that they had some exposure to China, but that came out before Liberation Day. They went into quiet period, so no one knew the exact amount. Last night, we finally got some color on that. All in, based on our estimates now, it's only about a 13% increase on the cost, and that's applying about a 145% tariff on the 15% or so incremental spend that they have on those machines. So it's something that they'll be able to get overcome over time, especially given the economics that these boxes provide for them over time, which is, just as a reminder, it cuts about 700 basis points of labor out of the store and then saves them about another 100 basis points on food costs over time. Like, this is something that's transformational for the company and the industry over the longer term.
Yeah, looking at that video is really cool. John, you mentioned that when tariffs hit and the markets went down, the New York activity for Sweetgreen kind of froze up a little bit, right? But markets have come back. So if there's a direct wealth effect, why aren't we seeing sort of more demand now?
Yeah, that's a good question. For them, they have more challenging compares. There's been, in the last year in the month of May, they introduced steak, first time on their menu, and they put a lot of marketing dollars behind it. Right now, they don't really have anything necessarily against it. Next week, you are seeing a new collab. It's called KBBQ. It's with Coat in New York. I believe that's the name of the restaurant. So there will be some news to fight against it. But, and they also have to start upping their marketing spend behind it. I think as we move throughout the year, the loyalty will become more of a tailwind. It's, from an accounting standpoint, a headwind right now. But as the year progresses, will turn into a tailwind. You'll have seasonal menu items coming back on, and then you got some easier compares as the year goes on, and they're upping their marketing budget, and you're still going to have Ripple fries coming through. So I actually like this story to the back half of this year. The stock will work as same-store sales improve, and I think the Infinite Kitchen in and of itself, longer term, is transformational for the company and for the industry.
That's why you got the buy rating and the $27 price target. We're trading a little under 15 right now. Hey, John, really appreciate it. John Tower, equity research analyst at Citi. What was it, Ripple fries? What's a Ripple fry?
So I tried these.
Ooh, okay.
Yeah, maybe a couple weeks ago. I mean, they're basically, they're. I don't think they're actually really fries. I think it's kind of like an air fry thing. They kind of use avocado oil or something. So they're just kind of like, kind of like potato skins-ish. So not really like French fries, but they're decent.
Were they Ripley?
Yeah, they were Ripley.
Oh, interesting. Yes. Okay, the things I learned from Romaine. Amazing. All right, coming up, we're going to speak to Tom Leighton, the CEO and co-founder of Akamai, the company's latest earnings results coming out, his outlook in this very uncertain trade environment. We'll get all of that from Tom. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Beautiful day outside. Nada happening in the market as well. We do have some reporting, though, from Bloomberg wanting to highlight about the Trump administration now identifying about 20 countries for early trade negotiations. Now, some of them are big, like South Africa and Japan.
Japan.
And some are smaller,
Japan's
like
big.
Fiji.
That's
and
not
Mauritius.
big. And that's not big either. But I guess it's progress, right? I mean, we're talking to 70 plus nations that they said in theory that they had lined up. So I mean, you got to start somewhere. And don't forget, you have the Treasury Secretary and Jermaine Greer, the USTR heading to China for the first formal face-to-face talks in all this.
So looking at what happens over the next 48 hours in Switzerland as well. And the idea, I think, is there be templates for some quick deals that could be done, maybe for countries that don't have a lot of drama, maybe like a Fiji.
Well, and that was sort of, I think, a lot of the optimism around this UK deal, if you want to call it that maybe, of course, this sort of sets the standard for maybe what other countries can use, and maybe that expedites this whole process.
In the meantime, though, when companies report earnings, they're faced with the continued uncertainty. The latest is Akamai. That stock down about 10%, falling the most since late February. And in that earnings conversation, saying that the direct impact to Akamai from tariffs in 2025 will be about $10 million in CapEx, which is amortized over about 6 years. Joining us now to discuss is Tom Leighton, CEO and co-founder of Akamai, a cybersecurity and cloud computing company. Tom, it's really great to get your perspective. That's for you guys on the CapEx side. What are your customers saying, and what would make them feel better about pulling the trigger for business with you?
You know, I think we haven't had any substantial impact at this time. We do have an increase in CapEx of about $10 million, which is not very significant overall. You know, there's obviously some concerns out there about a possible recession. If that were to take place, that could make bookings take longer or, you know, have some negative impacts. But so far, we're doing fine.
Are you seeing that business is delayed and deferred or still continuing apace?
So far, still continuing apace, you know, so we've not had the negative impacts, but I think there's just a general concern out there about whether the economy will move to a recession. The good news for us is that our products are really critical with security, and enterprises use us to protect their mission-critical applications, and that's a hard thing not to do or to choose not to do. And with cloud computing, we offer much less expensive capabilities than the hyperscalers. And so if companies do look to cut back costs, we've become an even more attractive option.
I am curious about your non-U.S. customers, Tom, particularly given the global climate right now, and you, of course, traffic in the business that deals with very sensitive things, in some cases things that might actually rise to the level of national security.
Yeah, you know, there has been some conversation and concern about, in some countries, about can they continue to rely on the U.S.? Now, I think they can, and for sure, I think they can rely on Akamai. And so we have had conversations to reassure customers, yeah, that we're going to be there for them. We keep data locally, so it's not an issue where it's leaving a territory. So that I think we're in a pretty good position there. But yeah, it's a conversation now.
Have you been having conversations, you or any of your deputies been having conversations with the current administration in Washington?
Well, not on this topic, no.
That was a short answer. Can you expand on that?
Yeah, no, it's not been a topic of conversation with government officials in the U.S. Of course, we work very closely with many U.S. government websites to protect them as well and to make sure they're operating efficiently. That business is going very well. There are some cutbacks in the government space, but nothing that's really material for us today. And again, you know, we can help the government save money, and that's an opportunity for us to grow our business in the federal sector.
Well, then speaking of that, so your two growth engines, that's security and also consumer compute products, I should say, they seem to be slowing a little bit this year. How can you reaccelerate that growth?
No, they're both on target. You know, security, our goal is to grow that at 10% off a $2 billion base. And with compute growing at 15%, pretty strong growth rate. And the new products in those spaces growing really fast, you know, with segmentation, which is mission critical, and API security. You know, our ARR, we forecast to grow 30 to 35% this year. And with our cloud infrastructure services that we compete with the hyperscalers, that's growing at 40 to 45% this year. So really spectacular growth in these new capabilities.
The other part is that core content delivery, the CDN business, also, though, a surprisingly strong quarter as well. For those that worry that that's more of a mature part of the business, what do you say to that?
Well, yeah, content delivery is a mature part of the business. We're the market leader by far, and it's a very good business for us. And we were pleased to see traffic growth pick up pretty much across the board in Q1. So that was good news, and we delivered a better quarter than I think we or anybody else expected for the delivery business.
Tom, I am curious about, and I just want to go back to something you were talking about, particularly when it comes to the security aspect of this. And we've been talking with a lot of folks who are developing AI products, and particularly some of these agentic AI products. And one thing that they always talk about is this idea of how much access to sort of allow into their ecosystem to sort of feed that. The idea that it is a major security concern of knowing basically who's coming through the door and, more importantly, who's leaving out the door and with what. How are you sort of addressing that with your existing or your potential clients, specifically in that agentic AI space?
That is a great point. Pretty much every enterprise now has a bundle of AI apps, and many of them agentic, which means that the AI app can take some action without human approval. And so you got to make darn sure it's doing what you want. And the problem we have today is that the cyber criminals have figured out how to compromise these AI agents and applications to make them do things they're not supposed to do. Maybe give up personal information or take actions that are the wrong actions. And so AI needs security, and it doesn't have it today. In fact, we just announced our new firewall for AI product a couple of weeks ago. That is critical, because without it, the adversaries are exploiting these AI applications and agents in a very damaging way. So you got to protect them. That's going to be a big area for the future.
How fast, though, is it changing? Because we talk about the scale and pace of technological advancement, and this seems to be much faster than anything we've seen in at least about 3 or 4 decades. And I am curious as to how you keep up with that, and more importantly, even governments and other folks who are there to sort of protect us and protect our companies, their ability to keep up.
It's remarkable just how fast, company like our company has probably over 50 different applications in different parts of the company. They're using AI. It's embedded in our products. We support it on our compute platform for our customers. They're using it. And it's going to be an arms race to secure it. So the first wave of attacks have come out there, and we now have the first wave of defense to protect the AI applications and agents. But this is going to be an arms race and a technology race, and it's critical to keep up and stay ahead on the defensive side.
All right, Tom, got to let you go. Really appreciate you taking time for us. Tom Leighton there. He is the CEO and, of course, the co-founder of Akamai. All right, coming up here, we're going to talk about the consumer and talk about tough times for travel, at least if you get a read of Expedia's most recent earnings. Those shares down about 8% right now on a worse than expected demand. A closer look in our stock of the hour. This is The Close on Bloomberg.
One of the worst performing stocks in the S&P is Expedia. Shares are down after the travel company lowered its full year outlook for gross bookings and revenue after it saw slower than anticipated domestic and inbound travel demand in the U.S. for the beginning of the year. The stock falling the most since April 3rd. Here to join us to discuss is Bloomberg's Jess Menton. What I'm so confused about is that it not necessarily was unexpected.
No.
Like, of course they're going to lower, and then the punishment feels so extreme.
We've also heard from the airliners. We heard from different hotels during earnings season, because we've already had more than 2/3 of companies report. And then obviously when you're thinking about more of those discretionary type companies, and then also if you're thinking about what's under sort of the umbrella of Expedia with Hotels.com and other different formats like that, unfortunately, when you're looking on an annual basis and what they were guiding for, especially for gross bookings, originally in February, they were expecting about 4% to 6% for this year on that growth, as well as for revenue, but they brought that down for both metrics with gross and then also for revenue about actually to 2 to 4%. So that's really why you're seeing that stock getting hit harder, but also bringing down some of its peers. But even year to date, it's still down about 16%. And if you're looking at, say, Airbnb or Booking Holdings, those aren't down quite as much as this stock. So it's had some issues when it comes to profitability, but that was a bright spot in the report, but people are still overlooking that right now.
Well, that's what I'm curious about. Is this something that's plaguing sort of third-party middlemen like in Expedia, or is this sort of, are we seeing the same type of softness, if not direct pain, also in the hotels directly, in the casinos, in the airlines, et cetera?
And that's something on the sell side research that they've been pointing out, to where it's actually kind of both factors there, just because a lot of it is pointing to, not surprisingly, when it comes to tariffs, but then also when it comes to Expedia specifically relative to its peers, it has more of a domestic type focus when it comes to where it derives its revenue. So about 2/3 of that being more domestic, whereas Airbnb and Booking Holdings, they get more of that demand from outside of the country. So they were actually, their CEO from Expedia was explaining about how inbound travel, specifically from Canada, was what was pushing a lot of that, because they weren't seeing as much demand there, and they saw people actually going more and traveling to Latin America more so than coming into the U.S., and that was a big factor that their executives were pointing out.
So what do we learn about the reaction function of the market to earnings when they miss? Like, what is our takeaway now?
So actually, those misses are getting punished more so, probably not surprising than in prior quarters, just because this is the first one that we've heard from, but also even the first quarter that's backward looking. So of course, it's all about guidance. So we like to look at those guidance measures from Bloomberg Intelligence. And right now, that guidance score, actually, when you're thinking about companies withdrawing, that's the worst we've seen since the depths of COVID. But then when you're thinking about the guidance score estimates, it's actually the worst in about a decade. That was back when we had the different things were going on with the European debt crisis, Greece debt crisis, and obviously that manufacturing data back in 2015, which seems like so long ago, right? But that's a big thing now, and a lot of companies also, I think more people were thinking more companies would withdraw guidance, but a lot of them don't want to withdraw it and then have to change that again if somehow there ends up being some sort of trade deals. But obviously there's a lot of things going on this weekend on that front.
Oh yeah. All right, Jess, thanks a lot. Bloomberg's Jess Menton joining us there. I mean, and to that point, tariffs are going to be 10% baseline for the globe. Like that's not changing. So
that's not changing, and that's materially higher than what it was before. But the market seems to have made their peace with it, at least for right now.
You think so? Even though it's been somewhat of a clearing event, has it though? Like, have we calculated those 10% tariffs?
I don't know. I mean, people have come on our program and said that. You know, whether you want to believe them or not, I don't know.
I mean, I believe them, but I'm so risk averse, so I think that's my problem.
Well, you got a market that's still pretty risk averse. I mean, despite the recent rally that we've had, we're nowhere near the higher levels that we had earlier in February.
Absolutely. And to that point, we're 15 minutes away from the closing bell on this Friday. Really calm day here. Marta Norton was Chief Investment Strategist with Empower Investment. She'll be joining us right after this. S&P pretty much flat on the day. Dow Jones off 0.3%.
Oh.
When the S&P was under 5,000, we put some money to work, but we're not there anymore. You know, our UBS call on the S&P is 5,800. That's not too far away from here. So I'm not looking to deploy in U.S. equities. I think you have to look outside of the U.S.
56.60 and change right now on the S&P 500. Brenda O'Connor, Juanas over at UBS, kicked us off to the close, saying there is some potential to get back to that 5,800 level. But of course, that would still be well shy of the all-time highs we set earlier this year, above 6,000.
Saying that we're still looking at 52 or 5,300 is not also out of the realm of possibility. We ain't getting there today, though. You're looking at a flat S&P, broad equity indices going nowhere fast. Energy outperforming. You're having oil outperform as well. It's hard to find like a real peg for that, so that makes me think it's a sort of repositioning and rethinking hedges across the board. But look, equal weighted index, the small caps, transportation index, those are all trading a little heavy today.
Yeah, and it's kind of the mixed bag, too. You talk about the action in the fixed income market as well. You're seeing a big bifurcation, a lot of activity on the shorter end of the curve, not necessarily on the longer end of the curve. The VIX slightly elevated here on this day. Dollar weakness on a rarity as we head towards what is potentially a weekly loss for financial markets here in the U.S. after 2 straight weeks of gains. Some big catalysts up ahead over the next few days, including the kickoff of formal trade talks between the U.S. and China, face-to-face in Switzerland, scheduled to start with a matter of hours. As we count you down to the closing bell, which is just, well, a matter of minutes away, let's bring Marta Norton into this conversation. She's Chief Investment Strategist with Empower Investment. All right, Marta, there's been a lot of talk here as to whether progress on trade could actually end up being that upside catalyst. And Alex and I were just talking in the past segment about this idea of how comfortable the market is with the idea that at bare minimum, we're still looking at a world with a 10% baseline tariff. Can you be comfortable with that?
I don't know if we've really taken into account how much of a shift that is, even if it is, to your point, just 10%. And I think a lot of the reasons why the market has recovered as it has from the initial sell-off post-Liberation Day has been a lot of talk around, trade talks and deals to be made, but also because we haven't seen a massive impact in the hard economic data thus far. That's what Chair Powell was referring to in the Wednesday conference, that hard data remains strong, the labor market remains strong. We're not seeing that, tariff push yet in inflation. And I think that has lulled the market into a sense of complacency. I would argue we may still have some volatility ahead of us as we start to see more of an effect in the hard data.
As we get that hard data, which data point are you most interested in? Which one are you going to watch the most for a sign that maybe things are getting worse?
Well, this is a bit of a ways off, but I think one of the first markers in this tariff war that we're in is going to be corporate earnings and what happens as we roll into the next quarter, what happens to demand, what we see in terms of cost management. That will dictate the prices that consumers pay. That will dictate the response in the labor market. And of course, we'll begin to see those labor market data points filter in over the course of the summer. We'll see what's happening on the inflation front. So, of course, I think the market is going to be watching those data points very closely, especially when we're looking at labor. I think it's not just going going to be the unemployment number, but it's going to look at, what's happening in hiring, what's happening with wages. That will get a sense for how uncertain companies are and how they're responding to any sort of cost pressure that they feel.
So what's the best way to look at it then? Sort of stay with the positions that you already had and just wait and see, right? If I'm not retiring tomorrow, like, is that a good strategy? I'm definitely not retiring tomorrow, by the way. Or do you need to start to rethink, like, how you're allocated in an uncertain environment?
Well, I know we have seen this broad market recovery post-Liberation Day, but I do think the volatility over the course of the year-to-date period has opened up some opportunity. Most notably, the Mag 7, which looked so nosebleed expensive at the start of the year, have really come down, of course, to DeepSeek, and then, of course, to some of this tariff pressure, concerns around how different technology companies are going to handle the cost pressure given supply exposure to areas like China and the like. And I think that is an opportunity, if there is some sort of faith left in the AI trade, to get into some of those names at a bit of a cheaper price point. So I do think, there are those opportunities that have emerged. But broadly speaking, in terms of, how investors are positioning their portfolios, I think diversification and breadth remain as important today as they had at the start of the year, just because we're facing so much uncertainty and there are so many different ways this game could go from here.
I wonder if one area where that's a little different, though, is the dollar. A dollar has clearly found stability, but hasn't had the same kind of momentum to the upside that we've seen, say, in the equity market.
Yeah, that's absolutely the case. Now, of course, it's worth remembering, and I think this is something that gets a little bit lost as we think about, U.S. exceptionalism and in the U.S. dollar, is just how expensive the dollar was entering into this period. It had been on, a multi-year run, and so there was some froth built up already, which I think has, allowed for this opportunity for the sell-off that we've seen. But absolutely, the currency exposure is something that's a little bit unique as we take a look at the various asset classes that investors are exposed to.
If investors are sort of looking for opportunities in this sell-off, meaning taking a look at some of the stocks that maybe they had their eye on that have now sort of dipped significantly in valuation, what is that conversation like? Because it's not necessarily just go in and buy hand over fist, or maybe it is. You tell me.
No, I'd agree. I think the broad market feels like it's not as expensive as it was at the start of the year, but it's certainly getting closer to more expensive than it was, say, prior the run-up in the wake of Liberation Day. But outside of the Mag 7, there are these areas like healthcare that look more reasonably priced than other sectors in the market. And here's a hairy one for you. The small cap area entered 2025 relatively cheap. At this point, it's absolutely cheap. It's at, kind of some of the lowest deciles that we've seen on a historical basis. So that is one of those areas of opportunity. But of course, if we're planning for a range of outcomes, if you're adding to healthcare, it would make sense, to small caps, it would make sense to also be adding to areas that are more defensive, like healthcare, that don't potentially have the same small cap exposure to the market. And then, of course, the Mag 7. So you can really diversify across the equity market.
If you're worried about inflation, is there a trade to be had there as well?
Well, on the inflation front, one of the things I'm taking a look at is the bond market. Now, of course, we've seen break-evens move higher, particularly in that 2-year area where folks are pricing in the possibility of a one-time price adjustment and inflation. But I think it's also worth looking at areas like TIPS that can protect in the event that we do get an inflation upside surprise.
Marta, have a wonderful weekend. Marta Norton is the Chief Investment Strategist at Empower Investment. And we should mention that Bloomberg LP does provide employees investment solutions through Empower. All right, let's get back to the broader markets as we count you down to those closing bells. Just about 2.5 minutes away. Stocks have been oscillating between gains and losses. Looks like they're going to finish the day in the red. Alex Steele as well as on the week.
Yeah, but today the price action is kind of crazy. There's just so much nothing happening.
Volume is incredibly light here, about 20% below recent moving averages here. A full breakdown of all of the days and the week's market action as we push ahead to the week ahead. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through that closing bell with the global simulcast that starts right now. Scarlett Fu in the TV studio, as always. In the radio booth today, though, Carol Massar and Tim Stenovic on assignment. Matt Miller fill in those shoes. I'm not sure if you're filling in Tim's shoes or Carol's shoes, but Nora Melinda will fill the shoes of the other as we welcome our audiences across all of our Bloomberg platforms. Matt, here on a day where we're seeing modest declines as we head towards the close.
Yeah, really very little change, right? The S&P down to 0.1%. And I was taking a look back to see how we've done this week. Also, very little change for the week. Very little change since April 2nd. We're basically unchanged at that 56.60 level since Liberation Day. Still off about 3% for the year, 1% since the election. But the S&P really hasn't done as much as maybe we would have expected it to after Donald Trump won the presidency back in November.
And if we're looking here on Friday, I mean, we're seeing energy is the best performing sector in the S&P 500 that we've been seeing, and real estate following right after.
You know what has moved a lot since April 2nd is the U.S. dollar. The Bloomberg Dollar Index down about 3.5%. So as much as we've seen the U.S. stock market, go down by a lot, make this sharp recovery and kind of just sit there at those levels, the U.S. dollar has been hit hard, and it'll be taking center stage this weekend as well.
Not to harp on it, but it's really hard for me to take any equity moves very seriously when there could be a lot of mechanical buying. I was mentioning earlier that Citi says if you have a swing under 2%, you have volatility-controlled funds have to buy equities.
Absolutely here, and you get the closing bells here in New York. An interesting day here, too. We talk about this idea of tight trading ranges. We talk about this idea of lower volume. You put that all together, and the net effect of it all is basically unchanged on the day. The Dow Jones Industrial Average takes a while for these numbers to settle, but it's down about 100 points, or about 0.3% here on the day. The S&P 500 lower by about 4 points, or less than 0.1% on the day. The NASDAQ Composite, we're just going to call that unchanged. Similar story for the NASDAQ 100, while the Russell 2000 giving up about 3.5 points on the day, or down about 0.2%.
Yeah, and we're looking at a drop of about 0.5% on the week, by the way, to 56.60 here on the S&P. The breadth is pretty unchanged as well. We have 239 stocks finishing up, 260 stocks finishing down, and then 4 unchanged, so more than 500 in the S&P 500.
All right, let's take a look at the sectors, and this is our IMAP. A pretty mixed day here. Energy was the best performers, gaining more than 1% as WTI climbs above $60 a barrel once again, hitting a high of 61. You also have gains in real estate investment trusts and consumer discretion, but these are fairly modest advances. On the flip side, healthcare and staples are among the decliners. These are your classically defensive sectors, down about 1.1% and 0.6%, respectively.
Just want a headline crossing the Bloomberg terminal right now for our viewers and listeners in the New York area. Newark Liberty Airport. This is in Newark, New Jersey, which has been facing a series of flight delays, largely because of staffing issues when it comes to air traffic controllers. We're now learning that the FAA here in the United States is weighing a broad pullback in the number of flights that can go into and out of Newark because of some of these radar issues. Remember, there were reports this morning of at least a 90-second radar outage that occurred at that airport. According to people familiar with the matter that our Bloomberg reporters have spoken to, U.S. aviation officials now plan to meet further on further flight cutbacks at Newark Liberty Airport, just across the river there in New Jersey.
Wow.
Yeah.
Well, a couple gainers that I'm keeping an eye on here on this Friday. I'm looking at microchip technology. Now, this is a chip maker. It's about $29 billion market cap here. And it said that the period marks the bottom of a prolonged industry downward cycle. Now, we are hearing Bank of America, they upgraded the stock to neutral from underperform. As we're really looking through these earnings, it's really lifting shares of other peers like Texas Instruments, On Semiconductor, and Analog Devices. They all rose at the close. And we did have microchip technology up about 12%, 13% to end the day. But also looking at Lyft, I mean, when we think about its competitors, Uber didn't really live up to expectations as we saw those earnings and broke them down. But Lyft did. I mean, its earnings were resilient. The company has really been keeping a lot of those activist investors away. And people are really just saying that this is a resilient company and it's doing well because if you look at the stock, I mean, slightly cheaper than that big name Uber. And some people like to arbitrage. So
were you not surprised by this 28% jump in the stock?
I mean, it's really a remarkable number, 28%.
But the valuation is so low compared to some of its peers. Mandeep Singh was saying, look, it's not going to take a lot to move that needle.
Right.
Well, we certainly saw that.
But
are you an Uber or Lyft person, Alex?
Yes. You got to arbitrage.
So you don't, I don't arbitrage.
You got to arbitrage.
I would go with the more affordable option, which is Lyft.
You got to arbitrage.
Definitely cheaper.
I arbitrage. But also, as we're looking at another name, I've got eyes on Yelp. Now, this isn't a website that I personally love
Is Yelp
to check.
still around, really?
I mean, it's around and it's on my phone. Okay,
wow.
Romaine, it's on my phone. When I go out to eat, I check it out before I order my food. But this is something I like to really look at. But we're seeing these first quarter results that beat expectations. The company raised the high end of its full-year forecast for adjusted EBITDA, and we're really seeing shares getting a pop off of that news. Yelp shares up about 9% at the close here.
Just real quickly, though, too, I do want to go back to that breaking news on the FAA. We actually now starting to see movement in some of the share prices, including United Airlines, which has an outsized presence at Newark Liberty Airport. Those shares now down, Matt, about 3% here in the after-hours trade. We're going to get you some more details on that, but we'll get back to some of the gainers and decliners.
Yeah, I mean, we can get back to the Newark story in a second as well, because Nora and I were talking about that before we came to you, and I think how bad is it for the U.S. economy if people are afraid to fly? Probably the best thing for officials to do is say, it's not all airlines and it's not the entire U.S. airspace. It's just Newark, in the armpit of America there. So if they blame it on Newark and stop that, maybe people will still fly a LaGuardia.
And we should point out, I mean, the airlines have been actually asking for a bit of a pullback for a while in Newark. So even before these current issues cropped up over the last few weeks. So it'll be interesting, too. I should point out, again, just citing our Bloomberg reporters here, 68% of the departures out of Newark actually are on United. So maybe that's why you're seeing such an outsized move in the shares here in the after-hours trade.
Yeah, I mean, it's down over 1%, and also during the trading session, it was down 4%. I mean, it's United Hub, so that's a big deal for that airline, Matt.
Yeah, only nonstop flight from New York to Berlin out of Newark. Let me get to some of these decliners. One of them is airline related, but the first is not. Akamai was at least one of the biggest losers in the S&P 500 in percentage terms. The company absolutely decimated, losing more than a tenth of its value after its results kind of underline the problems that they have. JP Morgan says we remain cognizant of the debt level, of the slow top line growth, of the margin pressures. And this is a company that, delivers content to you via the internet, and they're having a problem doing that. Expedia is another one that I want to talk about. And this is obviously the airline related. Although the kids tell me that
it's your demo.
Only old people use Expedia. It's my go-to.
You said that, not
right?
me.
And it makes sense because
Gen
of my
X
age.
Tool alert.
They missed results in the first quarter, and then their outlook also disappointed for the second quarter. Weaker than expected domestic travel, weaker than expected inbound travel because fewer people are flying
Why are you still using Expedia, Matt?
I don't know, because I'm 51 years old. In any case,
you're old.
The stock, though the stock has underperformed the S&P year to date and is down today, it's outperformed over the last 5 years. I will say it's up 126%. So it's been a winner over the last 5 years, and hopefully that's the case with me as well. Finally, Compass. It's a digital real estate company. First quarter adjusted EBITDA missed earnings in terms of loss per share and overshadows a boost to its annual forecast. I will say in terms of Compass, I normally anchor Bloomberg Open Interest every weekday from 9 a.m. to 11 a.m. on Bloomberg Television.
Look at that.
We have the CEO of Compass, Robert Refkin, with us on my program on Monday morning. So remember that over the weekend.
Amazing.
Every
time
There's
he's
something
in
else
these hours,
going on
he
this
does
weekend,
that.
though.
Yes, the trade stuff. Okay, let's go to the bond market. Nothing happened. All right, moving on. Let's go back to the Newark stuff here. And so this is actually a really big deal. I'm already back to the FAA trade.
Yeah,
they're like, there's nothing, not
keep
worth talking
going,
about the
Alex.
bond
Keep
market.
going, Alex.
So this is a really big deal because also if you divert flights, if you need to like LaGuardia and Kennedy, what does that wind up looking like?
Well,
they can't take
there's no capacity there.
Totally.
But this gets to the question as to whether now you're going to start to see a more material impact on people avoiding that airport. And I flew out of there just a few weeks ago, maybe like 3 or 4 weeks ago.
How was it?
It was fine. I personally didn't experience any delays, but there's been a lot of talk amongst people basically saying that they have seen a drop-off in activity at the airport as I guess people look for alternatives.
Yeah, and I wonder if the flights out of, let's say, JFK or LaGuardia are going to get more expensive as a result, because all of it is dynamic pricing on websites like Expedia or even the airline's own websites.
Or to your point, if you wind up paring back flights in Newark, do the Newark flights wind up getting more expensive?
Yeah, and this gets to this idea, too, of what sort of the government response is going to be. We're talking about really a lot of changes taking place right now with the Federal Aviation Administration and the idea that they have to address some of these, I guess, workforce issues, if you will. There was a great report in the New York Times just a few days ago that talked about the number of air traffic controllers that are actually working full time there relative to the number that would be, and it is a fraction of what it was even just a year ago, and that's a big part of the problem.
Yeah, and they work out of Philadelphia. They don't even work out of the New York area. So that's another thing. And that was all a matter of not just cutting costs, but also accounting for the fact that the cost of living in places like New York City, Long Island is way too expensive for a lot of the folks who work there.
By the way, cutting costs is the problem here, right?
Yeah.
I mean, these people hold our lives in their hands. You got to pay the women and men who are moving tin more, especially in this market. You want the best and brightest doing that kind of job, right? You don't want the losers who have to live in a town hours away.
High stakes.
I have to say that I called this must-watch TV, and I mean that. I watch this every day, the closed simulcast, so it's an honor to be with you. But I will say to your viewers, switch over to radio. We're going to talk to George Ferguson from Bloomberg Intelligence about this in just a moment. And I hope you join us for that. That does it for our cross-platform coverage of the market close on Bloomberg Television, radio, and YouTube. And a reminder that Bloomberg Business Week is now on Bloomberg Originals. We'll be back tomorrow at the same time, same place. No, not tomorrow.
Monday.
Yeah, Monday.
Our coverage continues right here on Bloomberg Television. A lot of talks about those trade talks set to kick off between the U.S. and China as President Trump floats an 80% tariff on China. That would actually be down from what he had previously proposed. Whether there's substance behind that, well, we're going to pose that question to Mary Lovely, Senior Fellow at the Peterson Institute. That's coming up in just a bit, right here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. I guess a sort of middling day on Wall Street and quite frankly for the entire week. The S&P, the Dow, the NASDAQ, all ending the day relatively unchanged, but all ending the week in the red. Modest losses to be sure here, but definitely a bit of a reversal from the past couple of weeks where we had seen pretty sizable gains. 59 and change right now on the S&P 500, right now in a somewhat range-bound area. You did have a few bright spots out there on the day, Scarlett, and that was largely in the oil and gas space and in the gold space.
In the gold space, yeah. And also in the ride-sharing space, at least Lyft, because the stock jumping the most in half a year after the ride-hailing company reported better than expected gross bookings last quarter. That was a surprise after rival Uber posted disappointing results. Also, Lyft boosted its stock buyback program. One of the losers of the day was United, giving up early gains after news that air traffic controllers and radar displays serving Newark Airport briefly lost communications early this morning. According to Bloomberg reporting, the FAA is now considering further flight cutbacks at Newark. And of course, what we saw this morning was the second outage in 2 weeks remains. So not great news for an airline like United that relies on Newark.
All right, let's get right to it here. The breaking news that we had a little while ago from our Bloomberg reporter citing people familiar with the situation that the FAA is now ready to consider additional cutbacks at Newark Airport. Basically, the number of flights that go in and out of that airport in a way to sort of match the number of flights with the decrease that we've had in the number of flight controllers operating out of there. Joining us right now is Bloomberg's Ryan Bean to talk a little bit more about what we know. And Ryan, what do we know? When we talk about staffing levels there, where are we?
Well, nationwide, there's a pretty pronounced shortage of air traffic controllers. Right now, there are about 10,700 certified controllers, which is about 3,000 shy of what U.S. officials have said are really ideal levels. The situation in the Philadelphia facility that routes planes in and out of Newark is a little bit more dire. It's closer to, I believe we've reported closer to 20 or so, and that's down from closer to more than 30 back when that traffic was routed from a facility in New York State.
Okay, so yeah, the lack of personnel is definitely one issue here. And we've had a couple of instances, the two outages inside 2 weeks, Ryan, that has really raised a lot of concerns. What kind of timeline are we talking about here if they're going to decrease the number of flights coming in and out of Newark? Is this a temporary solution? Is there talk of some longer term adjustment to the number of flights because hiring people, getting them trained up and getting them into Philadelphia and fixing all the technical problems behind the outages is not something that's going to be solved anytime soon.
No, that's right. And look, there's a number of things going on here. So what we just reported a few moments ago is that U.S. officials plan to meet with airline executives in the coming weeks, we anticipate, to discuss further reductions at Newark. Flight levels are already down there just due to just the aforementioned staffing shortages and runway construction. But beyond that, there's also efforts underway to try to fix some of the aging technology, both at the Philadelphia facility that handles much of Newark's traffic and nationally. The FAA on Wednesday said that they were going to be speeding, multiple types of infrastructure and telecommunications improvements at that Philadelphia facility. Caroline Leavitt, White House press secretary, earlier today said that the goal there is to have that physical work at that particular facility done by the end of this summer. And now beyond that, Transportation Secretary Sean Duffy earlier on Thursday, announced a sweeping broad plan to more fulsomely overhaul the nation's air traffic control system. He said that it would involve maybe some construction, but largely just replacing and upgrading and installing new modern equipment to replace this, what is really, fairly, what a lot of people would consider ancient. I mean, we're talking about floppy disks, paper strips, old mainframe type computers that are not what most people would consider to be modern.
All right, Ryan, thank you so much. Ryan Bean joining us from Washington. And again, Bloomberg reporting that airlines and U.S. aviation officials will be meeting to discuss voluntary flight cutbacks at Newark Airport because of multiple breakdowns in radar systems and communications. United Airlines shares extending their decline in after-hours trade. It's unusual for stocks to move in after-hours trade on a Friday, but we are seeing United, which does rely on Newark as a hub, extending its losses. Now, turning back to the broader markets, it is time for Factor Friday. And of course, as always, we have Chris Kane of Bloomberg Intelligence with us right now. Chris, just in a broad market perspective, give us an update on factor performance. What factors have been working this year and throughout the turmoil that began in early April and has since calmed down?
I would call it a classic flight to safety, when you look under the hood for the factors. So, defensive factors, stocks that really attract flows when people are scared, for lack of a better term, are really leading. So low volatility has been the king this year so far. Low volatility stocks have been high volatility stocks by about 7%. It's actually down from a few days ago, is over 10%. High profitability being low profitability as well as another defensive factor. Momentum's been kind of treading water, and then value's down 7%, which is, again, a cyclical factor, and that kind of just shows the risk-off nature of the market.
What does that say then about the conviction of the rally that we had? I mean, particularly we talk about what was a 12% drawdown on the S&P. We've recouped all of that.
Yep.
But are you seeing in those numbers and in that trade activity real conviction buying?
I would say no. I would say no, Romaine, because it's basically led by defensive factors. Even this bounce is led by defensive factors. Like, one of the things we did was compare April 2020 to the last month, because on the surface they seem like similar, right? They seem like big bounces after very acute declines. That's really where the similarities stop, right? When you see in 2020, it was basically like a risk fest. It was like people wanted value stocks, high volatility stocks, low profitability stocks. Now we're seeing the opposite. They want low volatility stocks, high profitability stocks. Basically, it's a very defensive market right now, even under the hood. And in 2020, it was risk at all costs. So it's very, very different behind the scenes.
All right, Chris, got to leave it there. Always great to talk to you. Chris Kane, every Friday, our Factor Friday with Chris Kane of Bloomberg Intelligence. When we come back, we're going to set you up for, what we should expect out of those trade talks between the U.S. and China. Treasury Secretary Scott Bessent on his way to meet his Chinese counterpart. Mary Lovely on her way to meet us, senior fellow at Peterson Institute for International Economics. She's up next, right here on the Bloomberg. All eyes turning to U.S.-China trade talks. The Treasury Secretary, He's heading to meet with his Chinese counterpart. This as President Trump floats an 80% tariff on China ahead of negotiations, almost half of what he had originally proposed. Mary Lovely joins us right now, senior fellow at the Peterson Institute for International Economics. And look, I don't know if 80% is necessarily better than, I guess, 150 or whatever it was on the table, but at least they're talking. We should be encouraged by this, right?
I definitely think we should be encouraged. There was a lot of doubt as to whether this meeting would occur so soon. The fact that they are meeting shows that each side realizes that the stakes are very high now. We're on the edge of really doing very serious damage, and maybe we can pull back just a little bit from the brink.
What do you think is going to actually be on the table, particularly on the Chinese side? I mean, we've heard from the U.S. to a certain extent. We know they want, some addressing of the trade deficit, but also, of course, of things like fentanyl and a few other things as well. What do the Chinese want?
Well, I think that the U.S. ask is actually still pretty unclear. The Chinese have been asking, what does the Trump administration want for weeks now? It's really not clear. Saying that you want to reduce the deficit or that you want to reduce barriers to U.S. exports is very vague. What the Chinese would like in terms of U.S. policy is clearly a rollback in export controls on chips, advanced chips, and chip-making equipment to help them with their own domestic innovation in the semiconductor area. But I think that's something that they're definitely going to come away from very disappointed. So the question is are there other things that they might be willing to settle for, and whether the U.S. is going to give anything. The recently completed framework, I'm going to call it, with the U.K. Really was mostly or entirely on the U.K. side, very little on the U.S. side. And I don't think China wants a deal like that.
Right. I like what you said about how it's not clear what the U.S. wants from China, and maybe that's part of this strategy, to be vague and see what the other side offers up first and pick and choose what you want. What is it that China is likely to offer then?
Well, China has said all along that it's willing to purchase more from the United States. We certainly saw that in the Phase 1 agreement that President Trump entered into to end the first U.S.-China trade war at the end of 2019. They will purchase more. Whether or not those purchases will be made, last time we didn't see the purchases being made, is another question. And Secretary Bessent has said that, we have to see some evidence that they're actually going to carry through with purchases. So the fact that he's even addressing this issue about lack of trust in any kind of purchase suggests that it's on the table. The Chinese would like to see lower barriers to investment in the United States, and I'm sure they'd be willing to invest in the United States, particularly, for example, in EV batteries and EV production. But that seems an area where the U.S. also doesn't want to go. So there are definitely things that the Chinese would like to see happen. Whether or not we can have a meeting of the minds is really the question.
Right. And that's why so many people say this meeting might be more about setting up the parameters for future meetings. Mary, Beijing also wants the U.S. to show some level of respect. How do you interpret that? What does that look like from Beijing's perspective?
Well, the language coming out of Washington has been very rough, to say the least. And China sees itself as a peer with the United States. The United States, particularly President Trump himself, has been touting the importance of the U.S. market and how the Chinese need to come to the table. The Chinese believe that they have things that the U.S. economy needs to sustain itself, with good reason. There's a lot of reasons to believe that what he's saying is true. And so they want to hear changes in language, changes in approach, and they don't want a one-sided deal.
Mary, always great to talk to you. Mary Lovely, senior fellow at the Peterson Institute for International Economics, as we await, of course, to get any sort of news out of those trade talks set to take place. And we should point out, too, Scarlett, I mean, the president himself is also going to be on a bit of a, I don't know if it's a diplomacy tour or trying to kick up investment. He's going to the Middle East, going to visit a couple of countries there. So you have a lot of folks from this administration fanning out to these foreign countries. And that's progress compared to maybe what we were seeing just a few weeks ago, where, they were just in the Oval Office trying to jawbone policy.
It is a big week for international diplomacy, and definitely be watching for what President Trump tweets out or posts on his Truth Social network, because I feel like he's going to be live blogging in many ways what he hears back from Scott Bessent.
Well, we addressed this earlier this week, too, this idea that you always have to see what the other party in those negotiations, similar to how we had the headlines out of this Trump deal with the UK, and then we got the actual headlines from Keir Starmer himself, and you could kind of see the disparity. So it'll be interesting to see the difference between what the U.S. says about these meetings and what China says.
You know
what
my prediction is? We're going to get concepts of a plan.
Concepts of a plan. Well, all right. Well, it's been a big international focus for the White House, and it's an international focus for us here, too. A focus on emerging markets when we come back after the break, including untapped markets in the Caribbean. We're going to talk to Marlene Street-Forrest, who's been running the Jamaica Stock Exchange for the last 20 years. This is Bloomberg.
The Caribbean has been ignored for too many years, maybe too many decades, right? This is what we should consider the front yard of the United States. And we think of coming out of the Panama Canal, Jamaica, Barbados, Bahamas, Guyana. These are growth stories, and they're being overlooked. And the Caribbean is the next investment frontier.
That was David Mullings, the chairman and CEO of Blue Maho Capital. His investment firm, it focuses on the Caribbean, and as you may have been able to tell by his accent, he is Jamaican to the core. And he talked with me a lot about money not only flowing into the Jamaican markets by meaning expats, but also now a lot of foreign investors who are also looking for opportunities as well. I'm pleased to say joining us right now is someone who knows a lot about what's going on with the Jamaican economy and, of course, their stock exchange, because she's been managing director of that stock exchange for more than 20 years. Marlene Street-Forrest joins us right now here in Studio 2 in New York. I want to start off with the evolution of the stock exchange. When you took over, we were talking maybe 20 listed stocks. You expanded that to more than 100. You took it from being just a main market to introducing bonds, introducing a U.S. dollar market as well. And, of course, overall, the number of subscribers or investors, or however you want to put it, that's grown exponentially.
That's correct.
Is that growth going to continue when you're gone?
Oh, absolutely. And the reason it will continue is that the pace has been set, the foundation is there, and the persons in Jamaica, they are really cued in to the stock market. And what we have done also is to educate the younger persons, so they will be coming into market, and that growth will continue.
A lot of the growth in the stock market itself, of course, was also tied to improvements in the economy. There were a lot of fiscal decisions that were made that really did pay off, and it put Jamaica in a better position economically than some of its Caribbean neighbors. What is the economy like now?
The economy is stable. We have a low inflation, we have low unemployment. So overall, the economy is stable.
I look at the performance of your benchmark index, and we just showed it, about up 1% in local currency terms over the past 12 months. If you look at this year, down about 3.08%, pretty much even with the S&P 500 in local currency terms. What kind of effect do you think the U.S. trade war is having on companies willing to come to market?
I believe that companies will still want to come to market. As a matter of fact, I think it is going to have the inverse effect, where companies will come because they will be seeking equity capital, patient capital, because they're of the uncertainties. And when there's uncertainty, you seek patient capital.
And the equity market is seen as patient capital?
Yes, the equity market is seen as patient capital because your shareholders are your owners. And because of that, you can determine whether you pay dividend, while on the other hand, if you were borrowing, you would have the banks coming to ask for their principal payment, their interest payment. So stock market is seen as patient capital.
I am curious, though, and we played a clip of David Mullings at Blue Maho a little bit earlier. I am curious as to, when we talk about the interest in the market, is it primarily Jamaicans who are currently living on the island, as well as Jamaicans that may be, say, in the U.S. or in Europe elsewhere? Or are you starting to see an inflow of capital from other sources, meaning people that weren't necessarily have any real affiliation with Jamaica or even the Caribbean?
Well, It's a mix. So for the stock market itself, the interest is mainly, primarily Jamaicans. And we want to grow that, so this is why we are also on road shows. But we are seeing constant interest from other countries into Jamaica for the wider growth.
When we talk about sort of expanding that and to this idea of sort of, when you were talking about the role of the public equity markets,
yes,
are you seeing any sort of new activity in private markets on the island? Because that's become a big source of stable, slow, reliable returns as well.
And the activity with private capital has grown tremendously. So much so that our depository, and trustee services, which is linked to ensure that you have a safe structure, that subsidiary has also grown because of private capital, yes.
Romain did a wonderful job kind of encapsulating the growth that has happened over the past 20 years, development of the junior market, the US dollar denominated market, the bond market. Talk about the role of technology as a driver in that growth, and what kind of role you see AI playing in the further expansion of that growth.
So technology was central to the growth, because unless you have a stable trading and settlement platform, the confidence in the market is not there. So what we did is, over the period, we ensured that we grew out the technology. We also had to grow in respect to so many things that are happening, like cybersecurity. If you don't have technology, you are not going to be able to focus on that and to have a strong and robust system. Data protection, again, if you don't have technology. So we use that in terms of the infrastructure. But again, we also use that in terms of the growth of the exchange, because we had things like online trading coming into place. And what we found is that captured the younger persons to the market. We also look at how do you increase confidence in the market. And from our subsidiary, we had the customer portal so that people could look at their securities, know what they have invested in, and again increase the confidence. Let us look now at market surveillance. Those things are critical to an exchange. And again, we put in market surveillance using technology to ensure that we are on top of the market and what is going on there. Again, AI, it is very important to our development. And as it is right now, we have just introduced the primary school game competition, and that is infused with AI to assist people, assist the younger ones in learning, in understanding the market.
I can definitely see this push towards really getting the younger generation involved in investing.
That is correct, yes.
Marlene, always a pleasure. Thank you so much for joining us today.
Oh, you're welcome.
Thank you.
Marlene Street-Forrest is Managing Director of the Jamaica Stock Exchange. I think it's time for us to go on a field trip to Jamaica.
I think so, too. And it's kind of funny because I think the first time we spoke to her on air here in New York was after we did a big feature. One of our colleagues went down to Jamaica. That's when it was like the best performing stock market in the world for like 2 or 3 years running. And
surprising a lot of people.
Yeah, but he took a close look at the economy. He talked about, how they restructured a lot of their debt, took some fiscal measures that really had a big
Tough
boost
medicine
to the economy, and it really sort of allowed it. So she actually did a great job and was instrumental in that as well. So.
All right, well, in the meantime, let's just get you a recap of what's been happening here in the U.S. On the day, not a whole lot, and on the week, you could kind of make the case that not a whole lot either, because we're all just marking time right now, Romain, for this weekend meeting.
And a lot of people are saying we could be range bound for a while. Remember, earnings season is dying down. We still have to wait for clarity on trade, and that may be what the market is pricing in. But, Michael Hartnett over at Bank of America, he said a lot of the upside's already priced in. So it's like, unless there's just some spectacular trade deal, I don't know, 56, 57, 5,800,
Perhaps.
maybe that's it.
We've been stuck in this range for a while, and we may be stuck there for a while to come. This is The Close on Bloomberg.
All right, welcome back. I just got back from the Milken Conference out in Los Angeles, and it's not just all finance folks and bankers out there. We had a chance to catch up with Ian Schrager. Of course, he is a legendary hotelier. He talked to us a lot about his new projects, the public hotels in New York and LA, and about the Trump administration and its expansion into other parts of the country. Take a listen.
I'm trying to appeal to a sensibility, not a traditional demographic. You know, either what we do resonates with you or it doesn't. You know, when you go into business, you could do something that's either based upon great execution, which Marriott and Walmart are probably famous for. You could do something on great service, which Four Seasons probably set the standard. Or you could do something based upon innovation, which is what we do and what none of the other hotel companies were doing, because it's such a capital-intensive business and nobody wants to take the chance on doing something that wasn't done before or that is new.
You have seen new entrants come into this boutique hotel, lifestyle hotel business, not necessarily big companies, but just a lot of individuals, wealthy individuals who have decided they want to be a part of this. When you interact with those people and you see what they're trying to build, do you think they're doing it right?
Well, wow. I wish somebody else would say this, but I still think we're the best at it. It was our idea. We do it because we love it. It originated with us. It's not something derivative. It's certainly not based upon design. It's not about a hotel in a different color. It's about a hotel that in some way connects to popular culture. And it's what makes me go, it makes me get up in the morning. That's still our approach. And I still like to think we're better than anybody else at it.
So I want to ask you, when you left Marriott, you said you were ultimately going to lead to expand your public brand. We're kind of waiting. You told Bloomberg you were going to expand.
Well, we are expanding now. The second property will open up in October in New York City, and we want to take it all over the world, because the idea of it, the concept, is to do a less expensive hotel without downsizing or giving only lip service to luxury. So it's true luxury at a less expensive price. And I think that's a modern democratic idea.
I really love that you say that, because I think at this conference, thinking about reaching more, Michael Milken said it about the American dream that is out of reach for so many people. When you say, what's a price point then that you think about that?
It all depends on the jurisdiction that you're in. If you're in a city like New York or LA or Miami or London, it might be a little bit higher, but you can have a price point as low as $100 a night. It depends upon the city. The point is, it should be at least a couple of $100 a day cheaper than a traditional lifestyle hotel. It should be accessible to anybody that wants it. Not only people who have money, but people who might not have as much money, but that want to stay in a kind of place that is not kind of diminishing the idea of luxury because it's less expensive.
Speaking of accessibility, the Trump administration, its impact on travel, perhaps. What do you think might be the lasting impact, or at least the nearer term impact of the Trump administration on travel?
Well, I don't want to get myself in trouble.
We don't want you in trouble either, but
I know Donald for a long time. In New York City, we were friends. He's a one-of-a-kind kind of guy. He's smart and bright, but when it comes to the political realm, we go in different paths, go down different roads.
You have such a kind of progressive approach to your hospitality brand. I think I can say in your thinking in a lot of ways, and you've empowered people to be, who they are with pride in your workforce. And I'm just curious, in terms of the Trump administration, the pushback against diversity, DEI initiatives. How are you thinking about that backlash as well?
I'm diametrically opposed.
Yeah, and in your properties, doing what you've always done.
They're diametrically opposed to that. I don't believe in that, and I believe in diversity, and I believe in having everyone have access to every single thing we do. I think it's a step backwards. I think it's where we came from. It's almost reactionary. So that's not something I embrace.
And that was, again, Ian Schrager, Chairman and CEO of Ian Schrager.
Let's get to some breaking news. The Treasury Secretary of the United States warning that debt limit measures could run out by August. The $36 trillion statutory debt limit, they actually hit that cap back in January, and the Treasury has been using extraordinary measures to stay beneath that cap. But Scott Bessent, in a letter to Congress, now saying that Congress needs to raise the debt ceiling limit by mid-July, or the extraordinary measures that the Treasury Department has been relying on may exhaust itself by August. Bloomberg Balance of Power co-host Kaylee Lyons joining us right now. Kaylee, I guess this isn't surprising. Are there any other details here that maybe gives us some sense as to whether Congress will actually follow through?
Well, Romaine, it's not necessarily surprising, as even the Congressional Budget Office, in its own ex-state projection, guessed August or September could be the time frame. But what the Treasury Secretary is telling Congress here is, based on the tax receipts the Treasury received in April, it does look like these extraordinary measures could be exhausted by August. And the problem, looking at the congressional calendar, is Congress doesn't spend the month of August in Washington. So he is encouraging Congress to make sure that a debt limit hike is passed in mid-July before they all leave town for that elongated summer recess. He notes the risk, though, of waiting until the last minute to suspend the debt limit, keeping in mind that we have actually seen the U.S. creditworthiness downgraded, and just the anticipation or the question as to whether or not the U.S. could go over the cliff, even though ultimately that has been avoided each and every time. And he does warn of that risk in this letter. This, of course, all factors into the current ongoing effort on Capitol Hill and budget reconciliation, as the Congress is not just looking at spending cuts and tax hikes as part of this massive legislation package, but also including a debt limit hike within it. So this really underscores the difficulty in getting this whole thing across the finish line in time to avoid potentially what could be a catastrophic scenario for the U.S. economy. So if the House and Senate aren't able to make adequate progress on a reconciliation package that would hike the debt limit, there is a risk here that that is an effort that is going to have to be separated out in order to get the limit lifted in time, which may take the cooperation of Democrats, which are, of course, in the minority in both chambers, as the Treasury Secretary here is warning that the clock is ticking toward the ex-state as they work their way through these extraordinary measures. Again, the Treasury Secretary saying August is when it will likely be exhausted, encouraging Congress to move by mid-July.
All right, Bloomberg's Balance of Power co-host Kaylee Lyons, she will be back on Bloomberg in about 20 minutes' time with more details. From New York, this is Bloomberg. All right, it is T-minus 2 days to Mother's Day, and one company is expected to ship 4 million flower stems for the holiday. UrbanStems is an online floral company known for its designer bouquets, sourcing flowers from around the world, including Colombia and Holland. Here now to share her outlook amid the economic uncertainty is the CEO of UrbanStems, Meenakshi Lala. Meenakshi, thanks for joining us. I want to get a sense of what demand looks like this year. I mean, Mother's Day is huge for you guys. It's kind of like the floral industry's Super Bowl. What kind of demand have you seen leading up to Mother's Day, and what do you expect to see over the next day or two?
Thank you so much for having me, Scarlett. And yes, it definitely is the Super Bowl for the floral industry. It is our busiest time period of the year. And we are expected, the floral business in the United States is a $35 billion industry. So it's massive. And NRF has projected a growth, and 70% of the popular gifts to give for Mother's Day are flowers. So it is definitely a big holiday for us floral folks.
Absolutely. And of course, there's a lot of concern over the economy, over trade tariffs, rising prices, whether people can hold on to their jobs. So there's definitely an intense interest in people trying to get the most bang for their buck. How are you responding to that? What are you offering in response?
So, we have always believed that the consumer is very mature and savvy today. They shop brands, and loyalty is earned through experience. It is no longer a given. It is no longer something brands can take it for granted. They're looking for premium product. They're looking for authentic messaging. It's no longer about just shipping high quality, fresh, on-time delivery. That is table stakes for our consumer today. They want innovation, they want personalization, they want storytelling. They want to see a connection with the purchases they're making, especially with the economic pressure on pricing this season.
So what is that story, though, Meenakshi? I mean, because when we talk about sort of, you put together a beautiful bouquet, but I mean, that's not a story in and of itself, or is it?
The storytelling comes through various aspects of how we position our product. As an example, our collaborations. This Mother's Day, we did a collaboration with Little Words Project and Goldbelly. We bundled jewelry and flowers. We bundled macaroons and Levain cookies and Martha Stewart's croissants to go with the flowers. And our consumer loved that. They responded really well to it. And these bundles are contributing to a higher average order value than last year's sales. And this was a result of us packaging the right mix for our consumers where even though there is price sensitivity in the shopping experience this year, we saw an increase in our average order value as a result of these smart collaborations. Also, last year we noticed at UrbanStems for Mother's Day sales, an average consumer was buying 1.4 orders, which basically signaled to us that folks wanted to gift more than one mother figure in their lives. Yeah. And we took that as a note, and our campaign strategy this year is to celebrate every kind of mother with our Mother Energy campaign. So we have products named like the auntie, the bonus mom, the Gigi. And my favorite, the emergency contact. As a mom of a 5-year-old, she's always on my speed dial, so I better be gifting her flowers.
All right. Well, now you're making me feel deficient here because I just, sent one to my, my mother and my mother-in-law. But apparently I've got a lot of other mother figures that I've forgotten about. But to that point, in all seriousness, too, just on the logistics side of this, you have a lot of people, quite frankly, Meenakshi, just to be frank, that are probably watching this right now and thinking, oh, wow, I forgot it was Mother's Day this Sunday. How quickly or how much can you deal with last-minute orders coming in? Like, what's kind of your cutoff time?
Yep. So we are collecting about 1,500 orders per hour as we speak. I am taking this call from our biggest fulfillment center outside of D.C. in Hyattsville, Maryland, and I'm watching it live. So our cutoffs, we will be in market shipping next day. We ship all lower 48 states, next day service until 9 p.m. tonight, and some states until tomorrow, based on the delivery zip you are in. But we service every zip code in the United States. We service Manhattan, and we service Bonanza, Colorado, which I was told has a population of 14 people. So if you have a mother figure there, UrbanStems can deliver flowers there.
Okay, or to all 14 people there. Meenakshi, we have to leave it there. Fun conversation here, and of course, if you haven't gotten your mother something, you definitely still have time to do so. Meenakshi Lala is the CEO of the online flower company, UrbanStems. All right, as we wrap up, it was a pretty interesting week here for financial markets. A lot of stuff coming next week. Remember, get the CPI report on Tuesday. You got Trump going to the Middle East, Scott Bessent in China, and a few other things. Not a whole lot of earnings. I think we get Walmart and a couple other things here that could potentially
reports
move
too, but it's all about what comes out of the administration when it comes to trade discussions.
We're going to hear from Jay Powell, too, which I think is Trump's least favorite Fed chair.
Yeah, I think it's going to be similar to what we heard last week.
Housing starts and UMich survey data on Friday. A lot going on next week, and of course, a lot still going on in the world of politics. Thanks for joining us here on The Close. Stick around. Balance of Power is up next, right here on Bloomberg.